I'd like to welcome everyone. I am Margie Douglas. I'm the program manager for the Small Business Development Center at Southwest Virginia Community College. And our team, Brittany Clark-Clayman is our marketing advisor, and Misty Bandy is our finance advisor. So we're really happy to have you with us today in honor of National Small Business Week. The Small Business Development Center is happy to present Developing Financial Projections, Predicting the Future of your business. Please note that this session is being recorded and all participants are muted in order to cover the material in a timely manner. But please feel free to type your questions in chat and we will address them as time allows. Today, our presenter is our financial advisor, Misty Bandy. Misty joined the SBDC team in June 2020 as a CARES counselor with an emphasis in finance. She came to the SBDC with experience in insurance, accounting, business management, small business entrepreneurship. Misty holds an associate's degree in accounting and business management and a bachelor's degree in organizational leadership. She has been a licensed property and casualty and life and health insurance agent in the state of Virginia for over 21 years. And now I present Misty Bandy. Thank you, Misty.
Hello, everyone. How are you? We're so happy to be here today and to cover a topic that sometimes is a little stressful to new business owners whenever they go to get funding and they're asked to to develop a business plan with financial projections. So our purpose today is to help you learn what goes into those projections, what figures you need to be looking at, and how you need to view those over the next 3 years. Brittany, if you can advance the slide for me. There are several different platforms that you can use to do financial projections. We are going to use the platform that we actually give to our clients here at the Southwest Virginia Community College SBDC. Remember, this is a basic understanding of what your revenue lines, your expenses, and funding avenues are going to be. We're not going to take into account any taxation strategies, capitalization strategies. This is a simple form to basically get your figures down on paper, to look at your business to see if the business is going to cash flow, what type of investment you need to put into the business to make sure that it's going to be successful. All right, we're going to cover today in this webinar is we use a basic Microsoft Excel spreadsheet packet. We're going to cover the income statement, the depreciation, the revenue projections, cash flow, wages, break-even analysis, and the taxes. So those are the topics that we'll cover on these Excel spreadsheets. So I'm going to go ahead and share my screen. Can we see that? You can. Okay. All right. Good. All right. On these revenue projection sheets, you'll see at the bottom, it's an Excel spreadsheet. There are several tabs here, working our way over from revenue projections, wages, depreciation. It covers 3 years of income and 3 years of cash flow, including retained earnings. There is a reconciliation sheet so you can make sure that your formulas are adding up, and a break-even analysis, and even if we can get to it at the end, the projected balance sheet. I wanted to talk to you first about how to predict and project your revenue lines. This will start off everything in your business, the way that you're going to go into business, and the reason why you want to go into business is to make money. To be able to sustain your business, you have to have revenue coming in to be able to keep the business up and going, to be able to purchase your inventory, to go through a yearly balance of ins and outs. Will make you understand, okay, where does my price point need to be? Where do I need to cut expenses? Where do I have the extra money to spend on maybe advertising? We are going to use a mock business today. And actually, I forgot to show that slide, but that's okay. We're going to use a mock business today. It's going to be on a retail store. It's going to be a woman's boutique. We've named our business BCD, Clothing Boutique. It's a small business. They will be renting their location, so we're not going to have any expenditures out for purchasing a building. This small business will be a brick and mortar business. They will not have any e-commerce business at this time. They are asking for a loan of $50,000. The owner is investing $5,000 into the business, and they hope to be awarded a $10,000 grant. So that is our mock business and where these numbers are coming from. I have started the first year of the revenue projection sheets. I always encourage you when you're getting ready to predict your revenue is to go out and to do some research, do it online that says, what does the revenue look like in this industry? Is the industry predicted to go up or down? What revenue lines are you going to have? Just because I have a small boutique, a small women's clothing boutique, I may not want to carry every line that every other clothing boutique in town carries right now. We want to be able to handle our inventory with the income that we have and with our initial investment. So I did go online and I did do some research based on what a small woman's boutique would carry and what number of products that we thought that they would be able to sell in a year. So we've started with, and I've pre-built some of this, a list of items that they will be selling. We've got shirts, shorts, pants, jeans, skirts, dresses, jewelry. And you can do research, especially through Ibis World, which the SBDC does have a subscription to that we can help you with. If you need to learn some information as far as statistics on your business. According to the research, I have broken the total number of items sold down into percentages based on what I have learned through my research. So when we're looking at these sheets, as you can see, we have shirts. The number of products sold as a small business owner, our small business owner thinks they can sell 2,430 shirts or blouses in a year. Their cost per unit is what they are selling those for. So they think that they could sell them for $25 a piece. When we put those figures in, it tells us what our estimated revenue is for annually, monthly, and quarterly for just those shirts and those blouses. I've added in the numbers just for time's sake for all the other items that are on here. Jewelry is something else that our small business owner thinks that can be a profitable line for them. So they feel like, based on their research, that they can sell 810 items of jewelry in a year. Their price point is going to be on a lower side of the price point, is going to be $15. And when we add that information in, this spreadsheet will automatically figure that based on what your annual revenue is going to be for the first year. So this is the starting point for your small business. The way that we do have these spreadsheets set up, this information, because that is a revenue line that we hope to continue into our year 2, since we're doing a 3-year projection, it automatically carries that inventory and those inventory items down into your year 2. Now, because we do want to grow, we're hoping to add additional revenue lines that can bring in additional money to our business. In year 2, we would like to start selling a line of shoes. We'd also like to add in a line of purses. That's an additional revenue line that we can add in simply into our store to bring in more money. Research does show that the average customer will make a 2.7 item purchases in one transaction. So if they come into the store, more than likely they're going to purchase 2.7 items. So we want to give them those additional items. We want to keep some lower price point items like the jewelry or the accessories, because that's something really simple that they can pick up to match with the clothing item that they purchased. This works with services too. Just because we're looking at a retail company today, all of this will work with your services. If you're a hairdresser, then you would break down the revenue lines as in how many colors do you think that you're going to do in a year? Start small though when you're doing these projections. How many do you think you can do a week? Then we multiply that by how many and figure out how many we can do in a month. And then we multiply that about how many we can do in a year. If you're a hairdresser, you may be doing haircuts. Men haircuts may be priced separately from women's haircuts. So our revenue source would be men's haircuts. How many do we think we can do in a month? what the price of those are, and that's how you build your revenue projections. So these spreadsheets or this formula basically is saying, what am I making money off of? What am I going to make money off of in every week? Am I selling shirts? Am I doing a welding job? How many welding jobs do you think you can do a week? How many hours are you going to put into that? What do you charge per hour? So these spreadsheets actually work with any industry and any service. You just have to make them specific to your service, your business. And this is a great way to build your business and to know the plan for years 2 and 3, because I call this our hopes and dreams. We're going to start in year 1, and this is the products that we're going to sell. This is the amount of products we're going to sell. Years 2 and 3, we're hoping to add on additional lines. We're hoping to increase our line of our number of products that we sold. So since we've went in and we've added in the shoes and purses, we want to show how many products do we think, how many shirts do we think that we're going to be able to sell in subsequent years? Well, we, through our research, know that that we're hoping to, so that the industry is going to grow a little, but our projections of what we want for our business is that we want it to grow by 5% in the year. So you can basically just take your first year total on your shirts was 2,430 individual shirts to be sold. We're going to up that by about 5%. And our shirt sales for next year are going to be $2,550 at $25. And we start building this just like we did in year 1. And it's very easy if you want to increase your price point. Maybe you start with a lower quality of items and you realize, okay, I sold that for $25 last year. I'm going to increase that and I'm going to sell that item for $30. That is totally up to you, but you need to be thinking about where your price point is, what type of customers and clients you want to get into the business. Who are you marketing to basically, and what is their discretionary income that they can go in and they can make those purchases. So as we go down through the list, it's automatically going to give us our figures. And we're hoping to sell 800 pairs of shoes and 800 purses. So basically, we now have built our revenue for year 2. Like I said, it's very important to understand your revenue lines first off, because that is the money that you're going to be able to make to bring into the business to pay your bills with, to pay your monthly expenses. So we went from total revenue in year 1 of $232,875 to $316,375. So this is how you're going to project for each individual year. Again, year 3, we're going into year 3. Let's say that we want to add on a household items. Maybe this is pillows. Maybe this is mugs or glasses or something that we want to branch out into a different revenue line. We have our store set up. We have the retail space to sell. We can add in an additional revenue line that can bring in additional clients. Maybe they didn't come in because they're not needing clothing or shoes, but they do need a new set, a new pillow, throw pillow to go on the bed, or a new comforter set. So always be looking for additional things that you can add into your business that will bring, that you don't have to spend a whole lot of money on to bring that new service or that new item into. Our small business is going to also offer an embroidery service, which is something that is you can purchase an embroidery machine. We have the location, we have the staff to take care of that. So we're creating a separate revenue line. Again, we're looking at, we want to do a 5% growth every year. So we're going to increase the number of items sold by 5%, an estimated of 5%, so that we can see where are we at in year 3. We hope to sell 1,100 new household items. That's a new revenue line, and do 200 embroidery services. Again, what is your price point for each one? Now, this can be an average. You may have a couple of different vendors that sell it at different prices. So we're just going to basically average these out. So if we put in our price points for all of our items, so we went to $364,100 for our revenue. So that's why it's very important to think of every possible revenue line that you can put in and how you want to grow. You don't want to be stagnant in your business. You want to be able to offer new lines and new items for clients to get people in the door. They may not be looking for that purse that day, but they may come in to have embroidery service. You got them in the door. Hopefully they're going to purchase something when they go out. So that is how we basically estimate our revenues. Everything starts from the revenue. So that's why it's very important to understand that. The next section that we're going to work on is going to be our wages. Now, you need to think about when you're building your projections, who's going to work in the business? Is it just going to be you? Are you going to be the primary employee? Are you hoping to have part-time employees that come in? Hopefully, as your business grows and you get busier, you will need to hire someone. But the projections on this, because payroll is a huge part of business expense. Okay, so we need to look at what can you actually perform the services or the duties without help in the business. Air Small Business has decided that because they are going to be open for several hours a day, at least 6 days a week, that we're going to hire some sales clerks. They want to hire 2 employees at approximately 20 hours a week per. We're going to look at the rate of pay of $11. Now, remember, minimum wage in Virginia is going up. It will be $11 in January. It will be $12 the year after that, and subsequently will go to $15. So we want to make sure that we're estimating properly. If we go in and we put a minimum wage at $9.50 and next year they're at $12, then we've underestimated our expenses. And we think that they're probably going to work 50 weeks in a year. So this gives us our estimated salaries that we're going to pay out. Now, if you as the small business owner decide that you want to be a W-2 employee, which means you want the business to pay their portion, the business to pay a portion of the Social Security and Medicare tax, then you need to be listed on here also. Just list your position, what your rate of pay is going to be, and how many days, hours, and weeks that you're going to work. If you decide not to be a W-2 employee and you decide to be just take owner withdrawals when the finances allow, we always encourage you as a new startup to not take any money out of the business at least for 1 year. If you can hold out for 2 years to do so, because we want to make sure that the business is able to cash flow. And if we're taking out all the money up front, if we've made $10,000 and we're taking $9,000 out, then we may not be able to, if COVID or another pandemic or something of that nature hits again, we don't have any cash reserves. So we want to build cash reserves. I always like to see at least 6 months of cash reserves to cover your monthly expenses. Sometimes that's hard in a small business. We are startups. So just be very careful about how are you going to pay yourself. Do you want to go in and do you want to make $60,000 the first year as a W-2 employee, or do you want to wait and see what your cash flow looks like? And you can take money out from there. So we are going to basically do the same thing that we did for our revenue lines. We are going to estimate what our payroll is going to be. In year 2, we're still going to have 2 employees, but our small business thinks that they're going to be busy, so they're going to need those part-time employees a little more often. So they're going to do 25 hours a week. Again, the rate of pay in that year is going to be $12 because minimum wage is going up, and they're still going to be working 50 hours. So as you can see on here, you can see that we have put in an estimated payroll expense of 10%. That is to cover the employer share of the FICA, the Social Security, and the Medicare, because you are required to pay the small business has to pay their portion and the employee has to pay their portion. We continue to build this. Again, we still think that because the owner is going to work full time in the business, that we can still get by on part-time employees, but we are going to hire an extra employee because we're building our business. We've got in year 3, we have the embroidery service. So that may be something that one employee can be doing while the other employees are waiting on customers or setting new displays. So we're thinking about what is those employees going to be doing, what jobs and tasks are going to be required in the business, and who will be doing those tasks. So we have basically built our our wages for years 1, 2, and 3. Okay, so we've got our revenue done. We have our wages done. The next section that we're going to work on is depreciation. Depreciation is a little scary because it is used in taxation. Depreciation doesn't actually come out of your pocket as far as the cash will not flow out of your business, but it is a way it will lower your tax liability. So we need to be able to account for that on our income statements, okay? So since our small business, each thing is listed here. You've got depreciation for buildings, lands, cars, furnitures and fixtures, equipments and appliances. There may be other things in your specific business that you'll be allowed to depreciate. Anything that you can use over a year. If you're going to get benefit out of that for over a year, then we encourage you to look at depreciation. Now, if you bought a laptop and it wasn't, but you only gave $500 for it, you may want to just expense that off in your first year because you're going to have a lot of expenses coming out. You may not need to use that depreciation over the next 5 years. You may want to take all that benefit off of your taxes in the first year. Basically, everything with the IRS has got years of depreciation that you can use. Building and lands can be depreciated over 39 years. Remember on your building and land, if you purchase a building, say you purchase a building for $50,000 and you immediately renovate that building and you put another $30,000 to $50,000 in it, you can depreciate that amount. So if we purchased a building for $50,000 and we put $30,000 of renovation in it, then we can depreciate $80,000 of that. So always remember to take into account the renovations that you've done. In our small business, though, our small business has a retail store, but it's a rental. So we're not going to have to do any depreciation on the building or on any type of land. But what we are going to depreciate is our furniture and fixtures, which is going to be our shelving, our display counters, anything that we are going to need to set up our store. When you go into the store, you're going to have shelves to put your items on. You're going to have display counters to put the items into. So we are going to actually depreciate that. In the first year, we estimate that we're going to have to spend about $7,000 to buy those shelves and those furnitures and those fixtures. Anything for displays, mannequins. Mannequins you would have to use those in a small boutique. Our equipment is going to be, we thought we would probably have to spend about $3,000 on equipment. That's going to be our registers, anything that we use, any type of equipment that we use to price our items with. Office equipment, you're going to have a printer, you're going to have a laptop, equipment that may go in your break room that you've got to provide, break rooms for your employees. So this is our estimates, is we're going to spend $7,000 on furniture and fixtures. That can be depreciated over 7 years. So annually, we're going to get to take off $1,000 off of our taxes for that. And on the equipment and appliances, that you can depreciate those over 5 years. So that's how depreciation actually works. And this will all transfer over to our income statement. Now, as you're building the business, and as we were building our business, we decided in year 2 that we were going to add on some revenue lines. Those revenue lines were going to include shoes and purses. You may not have a rack to put the shoes on. You may have to buy a specialty type of racking or display cabinets to put your purses. You may have to have the hangers. So we are going to estimate that we are going to spend an additional $2,000 on furnitures and fixtures in year 2 to be able to display those new items, those new revenue lines that we have coming into the business. So instead of depreciating $7,000, we will have now $9,000 to depreciate. And we are not going to purchase any new equipment or appliances at this time, so we're going to stick with $3,000. So when you're looking at depreciation and you're estimating and projecting those numbers, make sure that you're thinking about, what are my sales? What are my revenue items going to be? Am I going to have additional things or additional equipment, additional furniture, fixtures, additional display items, additional pricing equipment to take on those new revenue lines, those new items that you've added in? So we're going to continue this with year 3. Year 3, remember we put in the household items and the embroidery service that year. So household items, again, if you don't have a lot of display area or display cases, you may want to purchase some additional ways or fixtures to display those new items. You may be looking at that you want to, you go into Belks and things like that. They have this when they have comforters and things, they like to have those nicely displayed out. So you may want to purchase the items that can help you with those actual displays. So in year 3, again, we're going to purchase another $2,000 worth of furniture and fixtures. And for our equipment, because we are going to pick up the embroidery service, we want to be able to purchase that embroidery machine. So we're going to estimate that embroidery machine is going to cost us about $2,500. So we're going to add that to our original $3,000, and we're going to be able to depreciate $5,500 this year because we purchased that embroidery machine. That leads back to our inventory lines because we offered a new service in year 3. So, as you're looking at this, be sure that you're looking at what am I doing in year 1? What am I doing in year 2? What am I doing in year 3? What revenue lines do I have? What do I need to do to purchase, or what am I going to have to do to set up that new line in my business? Whether it's a service business, if you're welding and you decide that you want to do a different type of weld, you may need a different type of welding machine, and that welding machine will cost you money, but you can depreciate that. What year are you purchasing that item in, so we can make sure we're putting that in our depreciation. Moving on to the next is going to be our loan amortization schedule. This is a pretty simple form that we use that is built in. All of these numbers are actually transferring over with these Excel spreadsheets on the This is the platform that we use, and that's why I like it, is because the numbers are going to transfer for you. All these figures that you're putting down on paper are going to roll over into your income statement and your cash flow. So with our small business, our small women's boutique, they are going to get a $50,000 loan. And we're just estimating that they're going to be able to get that at a 7% interest rate for 10 years. And they're going to make a payment every month on that. And let's just say that they're going to start those payments on November the 1st. So this spreadsheet basically tells you what you will be paying every month. This is excellent to have this information up front, because if you can get the loan, that's awesome, but you have to be able to make the payments on the loan too. So I encourage you to make sure that you're speaking with your funders, your lenders. What are the terms of my loan? A lot of times loan and bankers, commercial banks will say they can give you, a balloon at the end. They can lower your payment at the beginning, but you're going to have a big payment at the end of that 10 years. So understand what you're actually signing, okay? But this is a good representation of what a loan would be when it's all amortized out. So basically our beginning balance is $50,000. Our scheduled payment is $580.54 a month. As you see, though, the only portion of that is going to principal is $288.88. $291 of that is going to interest. So you need to understand where your money is going, and that just because you're making that $580 payment a month, only half of that is basically going towards your actual principal. So you can play around with these figures. If you have more than one loan, if you've determined that you've got more than one loan, maybe you've got a loan through a private investor and you're making payments back to them, you may have to have 2 amortization schedules. Break those down, understand exactly who you owe money to, when you owe it, and how much you owe. So that you can always add an extra sheet on this platform for the loan amortization schedule. And when we get to the income statement, all those figures that we have been looking at are on this income statement. So we went in and we put our revenue in. See if I can get it over here. All of those figures have transferred over for us, okay? We've transferred all the information over into month 1, month 2, everything that we are looking at these revenue lines for year 1. So if we go back to our revenue, get back up here. For monthly, our shirts, we're at $5,062.50. So that figure is showing here. Now let me correct this. We want got a little error. Sometimes when we pull these sheets up, they don't always transfer like we want them to. So what you can do on this spreadsheet is you can take very simple. We want each month to equal our monthly average. Now, in specific businesses, you know that there may be a month where you're going to have stronger sales than the first month. Okay. So if this month is, say you're thinking at Christmas time that you're going to have more sales, you may want to look at, instead of averaging everything out over the month, you might want to look and say, okay, I think my sales in December are going to be a little higher than my sales in, let's say, February, when people have just went through Christmas. They don't have a whole lot of discretionary income left. So you can always go in and change these numbers. So shorts, maybe, we're starting this business in, in December. Maybe we're not going to sell a whole lot of shorts. Maybe you want to take those figures, this figure, and say, okay, I'm going to take this figure and I'm going to put it down in June, July, someplace like that. That's totally up to you how you want to average everything out. What we're going to do is, just for time's sake, I'm sorry this didn't transfer over like I needed it to, but we're going to make sure it all works. For time's sake, we're just going to equal everything out here, as if we are just looking at that we're going to sell about the same amount every single month. All right, so air revenue for each month is going to be approximately $19,406. That is what we estimate that we will bring in off of our sales every month. Now let's talk about our cost of goods sold. Our cost of goods sold basically it's going to be your beginning inventory plus your purchases minus your ending inventory. That's how you come up with cost of goods sold. The way that we are doing this is going to be on our profit margin. We are estimating that when we purchase a shirt or we sell a shirt, that it cost us 40% of that sales price to purchase that shirt. So we've got a profit margin of approximately 60%. So what I've done is I've actually just went in, and you can do this manually. You don't have to put the formulas. If you don't understand Excel, you can manually put these figures in there. What I've done is set it up to basically take my cost, I take my sales, the total sales for my shirts, and I multiply that by 40%, and that's how I get what my cost of goods sold are. This is how much that I have to pay for that item that I'm going to sell. So if you pay me $10 for the shirt, I had to pay $4 for it, then I only made $6 off of it. So when you're figuring your cost of goods sold, now we're not taking into account what the wages were for someone to box or fold that shirt or anything like that. This is just straight material cost of what it's costing us to purchase that item so that we can sell it to our customers. So we're going to take our total amount sold minus our cost of goods sold, and that gives us our gross profit. Now, from our gross profit, we are going to have basically expenses. We're going to have monthly expenses that we are going to have to pay out. These are things that you will need to research in your business. Some expenses are going to be industry specific. If you are a welder, you're going to have gas to run your welding machines with. That's going to be an expense to you. If you are a beautician, you're going to have shampoos and things of that nature. In a small business with any type of small business, if you've got a brick and mortar, you're going to have restroom facilities. Are you going to have to stock those with cleaning supplies? Are you going to have to stock that with toilet paper or things like that? So make sure that you're considering what your small business is and what specifically you will have to be putting into that small business to keep it running and keep it up and keep it open. We're going to talk about a few of these. If you'll look at the accounting and legal fees, this you'll need to look at based on what are you going to do, who are you going to have to do possibly your payroll. Are you going to take care of your payroll every month? Or are you going to have a CPA or an accountant take care of your payroll? Are they going to do it every payroll, or are they just going to file quarterly reports for you at the end of each quarter? How much is your tax return going to be? You need to take in all those little accounts because all of that money adds up. In our small business, we as owners are going to go ahead and we're going to take care of our paying our employees every week. We're going to take care of writing those paychecks, but we are going to have a CPA do our quarterly filings. That's our 941 filings that go to the state, that goes to the federal government, that we pay all those withholdings that we've taken out of our employees' paychecks too. So we're going to say they're going to charge us $200 every quarter to do that. Now, first year, we won't file our taxes until probably February, March of the next year. So we're not putting in any information here for a tax return. But remember, that second year, you are going to have to file a tax return for the business. So you may want to go in and say, okay, ask your CPA, how much is this going to cost me to get my tax return done? So if they say it's going to cost $800, then you're going to add that information in there. Advertising is huge. How are you going to advertise? There's lots of free advertising platforms out there. But do you want to do maybe a billboard? Are you going to do Facebook? I know will let you do paid advertising. So we're going to say our business is going to spend about $150 a month on advertising. That may be on the marketplace. It may be just on Facebook, maybe ads in the local newspaper, maybe that we're making flyers, things like that. What are you going to spend your advertising money on? When are you going to spend your advertising money? Your business as a boutique, Christmas time is a big time for people to shop. Maybe you want more advertising to be done in October, right before the holidays. So you may want to put more money in the month of October. So think about when and where are you going to be able to spend your money. As far as car and travel, not every business will have a car and travel expense, but our business will, because we're going to go to trade shows. We're going to go to trade shows to learn what new products are out there and buy our stock. So we're going to spend about every quarter, we're going to travel to a trade show. So we're just going to put that we've got $500 in there. Our insurance, this is something that is going to be industry specific to you. So you're going to need to figure out and contact your insurance agent to find out how much is my insurance going to be? What are the terms of the insurance? Do I pay it all at one time or do I pay it monthly? Usually insurance companies will let you pay on a monthly basis. There is usually maybe a $3 to $4 or $5 fee to do that, but that may be something that you need to do in the beginning until you build your cash flow and your revenue. We're going to estimate that we're going to pay in about $1,800 in insurance, including our general liability and our workers' compensation. Now, remember, as you make more money, a general liability policy is based on your revenue. So next year, as your revenue goes up, your insurance is probably going to go up. Your workers' compensation is based on how much you pay your employees. If your hours of your employees go up or the pay rate goes up, then basically your workers' compensation is going to go up. So you have to review that every year. That's not something that's going to be a standard for you. Licensing fees. If you're an LLC, our small business is an LLC. So we know that we're going to have to pay that $100 up front to get our LLC licensing. There may be $100 that we have to pay to the county or so to basically get licensed and be registered with them. So we're just going to estimate that we need to pay $200 to start our business. This is something that will occur next year too. You have to pay your renewal fee. So make sure that we're looking at that. Miscellaneous expenses. Miscellaneous expenses are those things that we just don't know know exactly what they are. I always encourage you, though, to put some money in miscellaneous expenses. You don't know that there's certain things that are going to pop up that you're not sure that you even would have thought of that you're going to have. So let's just put a little bit of money in there. We're going to say that we're going to spend $100. Just set aside $100 and set aside $1,200 every year for miscellaneous expenses. We will not have property taxes because of the fact that we are renting our building. So our building with our lease is going to be $1,000 a month. that needs to be estimated and put in here. Make sure you're understanding what your terms are of your rental lease. Is it including any type of your utilities? Are the utilities included in, or is it something that those things you're going to have to take care of on your own? Repairs and maintenance, who knows what that will be? It could be the little thing of you may have a shelf or something that breaks and you need someone to come in and fix it for you. You may have to have, the handyman come in and work on, maybe you have a light fixture that's not working right, or anything like that could pop up that you would have to repair. Make sure you're estimating something for that. So when we basically have our miscellaneous expenses at $1,200, and we have repairs and maintenance at $600. That's money there in case you get into a hard time that you need to be able to put some money out there to fix something or to keep the business up and running and keep it up and looking nice for your customers. Supplies are going to be based on what is your business. Our supplies in a small boutique is probably going to be cleaning supplies. It's going to be restroom items. It may be if you're doing printed receipts, it may be cash register ink, anything like that, printer ink. So we want to make sure that we're estimating what supplies are we going to have in the business. If you're a welder, again, you're going to have welding sticks. You're going to have gas. If you're a beautician, you're going to have foils, combs, brushes, things of that nature. So we want to make sure that we're estimating for those. Telephone, everyone's got to have a telephone nowadays. We're just going to say that we're going to pay about $60 a month for a telephone. Utilities, again, is something that you can basically estimate based on, where you're at. When do you think your utilities are going to be? Of course, it may be in March and April. We're not going to use as much heat. So maybe it's going to be a little lower. So we are going to estimate $250 a month because we're going to go on the budget plan. And I do like the budget plan, especially for small businesses. If your electric company will allow you to go on the budget and pay a set amount every month, then that will help you budget out your year's expenses. It's a lot easier to pay $250 every month than to pay $80 one month, and then it come up in the wintertime and you've got a $600 bill. So, it kind of messes up your cash flow a little bit. So if you can get any of those utilities put on a budget, then that's great, because then we can firm down your numbers a whole lot better, and you're not having those big, large expenses maybe at a time when you're not making as many sales. Again, water and sewer is the same way. We're just going to estimate that we're only going to spend about $50 a month on water and sewer. So that basically builds our expenses, what we project our expenses are going to be for the year. So we have to take that out of, we had our revenue, we took out what our cost of goods sold was, and now we're going to go ahead and we're going to take out our expenses. That gives us our net profit for the year. Our net profit for the month is automatically figured. First month is going to be $6,626.33 for the year. Now, this is before taxes. Is going to be $79,000, $79,02941. So now we have to figure out how much of that are we going to have to pay taxes on, because the government is going to want their portion. Now, these are just rough estimates on the taxes. Basically, the taxes are going to be individual to how you are taxed. If you are an LLC, you can choose to be taxed as a sole proprietor, or you can choose to be taxed as a corporation. That's something that you will need to speak with your CPA about, and it's to choose which way is more beneficial to you yourself or to the owners of the business. So this is just a general guideline. So these numbers are not going to be firm. It's just a general guideline to say, okay, I do realize I've made this money. I'm going to have to pay taxes on it. So in the for this tax, we're going to estimate that we have the net profit, and we have a little chart down here. So we are in at $79,000. We're in the 28% tax bracket. So how we figure that is any amount over $77,100 is going to be taxed. I'm going to use a Excel formula here, but you don't have to. You can actually just figure this on your own. So we're going to figure out anything over the $77,100 is going to be taxed at 28%. And then we have to go back in according to our chart, and we have to add back in the $15,698.75. And that's going to give us our estimated taxes. So basically, on our $79,000, we are going to pay $16,000 in taxes. It's a large sum. I know it's shocking how much taxes it is, but you do have to estimate for it because it is going to come out of your business. So when we do that, that number carries back over to our income statement. And on our income statement, basically, it says after taxes, we made $62,790. So that is building your income statement there. The next step is going to be your cash flow. Your cash flow is a little different from your income statement because this tracks the cash in your business. You may have a month if you had to have a lot of outlay or that electricity bill was high, that you didn't make any profit in your business. That's fine. But you have to have good positive cash flow because if you don't have good cash flow in the business, you are not going to stay in business. How we build this, where the income statement was based on a yearly, month by month, this basically is looking basically at your checking account. Your checking account basically is going to say, all right, how much cash do we have on hand? Our cash on hand was $5,000. We did get a loan for $50,000. We're hoping to get a grant for $10,000. So this is our cash on hand right now. Before we pay anything out, we invested $50,000 with a loan. We've got a $10,000 grant. We put $5,000 of our own money in, and then we made this month $19,000. Okay, so that's the total cash in the business. We're going to take out our cost of goods sold. These figures transferred over from your income statement, so you don't have to go back and refigure those. Then we're going to take out all of our expenses. These are the expenses that we entered on our income statement. It figures in we do have to make a loan payment. This breaks it down as we paid interest at $291. Our loan payment was $288. So now this capital purchases or injections, this is where we're going to put in what did we spend that $50,000 on that we got the loan for. We needed a loan to purchase something. We had to purchase basically our furniture and our fixtures and our equipment, and we had to purchase inventory. So basically we purchased $10,000 in furniture and fixtures and equipment, and we purchased $40,000 in inventory. So we spent $50,000 out of that money. So we have basically spent that major part up front. You've got inventory that's going to be left at the end of the year, hopefully because we want to turn over our inventory quite often. But as we sell off inventory, we're taking the money that we made off of that and we're repurchasing that inventory back again. So every month we spend $7,762.50 on inventory. So out of the money we made, we're reinvesting every month to make sure that we have, this basically averages out to be about 5 months of inventory in our store, which can roll over throughout the year. So beyond that, we've got owner's draw. How much money is the owner going to take out of the business? Like I said, in the first year, if you don't have to take anything out, it's a great idea not to not take anything out of the business to make sure that it cash flows. Our business looks pretty healthy, though. We do have some cash at the end here. Without taking anything out for the owner, we have $75,810 cash in our checking account at the end of the year. So the owner has decided, yes, they want to take some money out of the business. Our owner feels pretty comfortable that because he is repurchasing his inventory every month and restocking every month, that he's going to be okay, that he's going to have new items in the store. So what's going to happen is he's going to say, okay, how much do I want to take out as far as to live off of? So our owner has decided that he thinks that he will be able to take, let's say, $5,000 out every month to live off of. This is for him to pay his monthly bills, to pay, food, clothing, things for himself and his family. So he's going to take $60,000 out every year, which at the end of the year means that the business is going to be left with a cash of $15,810.51. So we have positive cash flow for the year. Okay. When you're looking beyond, this is all for years 1. When you're looking at years 2 for your income statements and your balance and your cash flow, we've got those set up to where we are basically looking at those on a quarterly basis. This will save you some time because, we kind of understood where our revenue is coming from. We understand where our expenses are. So instead of doing it monthly, you're more than welcome to, if you feel like that you want to do it monthly, that you get a better grasp of that. That's great. Go ahead and break it down and do it monthly. So once we get our years done for our income statement and our cash flow, the next thing I want to show you is the biggest thing is this break even. Break even is a great tool to determine what you need to do and how your business needs to perform to make sure that you're able to stay in business. What this has done, what these charts have done is it's taken the figures that you have put in on your income statement and your cash flow statement, and it's transferred them over into this year 1, years 2, year 3. If you'll notice, there's a 5% variable here, and you can make this number any amount that you want it to be. So we're saying in year 1, we're going to spend $800 on accounting and legal fees. This second column is saying, but what if we underestimate that by 5%? So if we underestimate that by 5%, then we would actually be spending $840 instead of the $800. And this will show you, let's say that we underestimate all of our expenses by 5%. So instead of paying $155,000 out in year 1, we end up paying $163,000. This gives us an idea of where the minimum is and what the maximum that we feel like. It's a kind of the worst case scenario, best case scenario type thing. So how we get our average unit price is, I base this on the research that I had done, is that a typical purchase is 2.7 items, and they typically spend about $54 is what a typical purchase would be based on my research. So if I have expenses of $155,000 a year, and the average customer or the average sale or the average customer is going to spend $54 at one single time in my store, then how many sales do I need to make a year? I need to make 2,886 sales a year at $54. If I overestimate or underestimate my liabilities, then at that 163, I need to have 3,030 sales for the year to be able to break even. That way you have a goal. It's always best to have a goal, to know where you're going, what you're going to do, where is the money going to come from? What are my projections? If you've got, 2,000, if I need to make 2,886 sales a year, and there's 365 days, then I need to make almost 8 sales a day of $54 a piece. So it helps you to have a goal and to see where you're going really quickly to have these figures. So I think that's about what we have time for. There are a couple more sheets on these projections that we have. And like I said, this is just the platform that we use. We just hope that you understand that, when you're thinking about your projections, think through the entire process. If you add on a revenue line, what cost is associated with that? If you hire an employee, what cost is associated with that? Where do your price points need to be? And how many sales do you need to make at a specific amount to be able to have a thriving business? So that's all I'm going to go with right now. I wanted to leave some time for some questions. So is there any questions that I can try to address?
Misty, there is a question in the chat box. How did you arrive at the 5% increase?
5% increase. There is, like I said, the SBDC does subscribe to the IBIS World report, and that report is excellent. It gives you history on the industry, industry specific. We go in and we say, okay, I want to look at a women's boutique. And it will tell you what the projections for growth is over the next 5 years. Now we're talking about 5% growth, right? Or are we talking about 5% over? I'm addressing the 5% growth right now. So I looked at that report and said the industry looks like that the industry is it is going to grow from 2020 because of the pandemic and because of COVID. So it looked like it was probably going to grow somewhere around 2%. I wanted to aim my store a little higher, my mock business a little higher than that, because I wanted to think more on the positive side, because I feel like that when you look and say, how are you going to be different? If you say the industry, we look at IBIS rule reports sometimes that say that the industry is expected to go down. Don't be discouraged by that. It's how are you going to address those threats or overcome those things going down? Because the industry was going to go down, but the embroidery industry looks like it's going to go up because the personalization of items is going to go up. We're adding in that that extra revenue line in year 3 to help build that revenue, because that industry is going to come back. So there is reports out there. Just do some research online. The IBIS rule report that the SBDC can provide you is a great tool.
So basically, it's up to the business to do the research. And if you are a client of the Small Business Development Center, we're happy to provide you with the IBIS World Report, which is a subscribed report, and it is copyrighted. So we feel that it is very beneficial. Misty, thank you so much. I don't see any additional questions unless someone else has one. Please feel free to unmute yourself and ask. But we really appreciate everyone that has participated today, and we hope that this has been beneficial. We would encourage you, please, to complete the survey that we will be sending out shortly. And we are happy to share our slides and the spreadsheets. We would also like to tell you about 2 additional workshops that we are having this week. On Wednesday, we will be hosting at noon, Business versus Personal Credit Score, and our guest speaker will be Sabrina Davis with Fulton Bank. And on Friday, September the 17th at noon, use YouTube to grow your business. It will be presented by Brittany Clark-Clayman, our very own marketing expert. So we hope that you will be able to join us, and we just really thank you for joining us today.
Thank you all.
Bye.